thank you to everybody for spending time with us tonight. We know there are other things you could be doing, but the market has been crazy and the developments in the bond market seem to offer some excellent alternatives and remedies for a volatile market. So we wanted to make sure we got this information to you in a quick and timely manner. Obviously, well, not obviously, but most of you have heard me make a presentation before, and I'm happy to be doing it again. We also want to introduce Ryan Breen, who is a new advisor to the team, and Ryan has a long history in the area in which we're going to be speaking tonight, so he'll offer some good insights. One of his many areas of expertise is the bond market, so we'll get his views on things. But before we launch, Dave, why don't you give your disclaimer, sort of like those Johnny Carson days on TV.
Well, Charlie, that would be that the views expressed are those of Riverside Financial Group and are not those of Cambridge Investment Research. Enjoy the show.
All right. Wow. You sure you haven't done this in another life? All right. So again, thank you to everybody. We're here to talk about bonds. Bonds, how they work, how they differ, how they help. So we're going to go right into it, and we'll keep it brief. And when we're done, we'll just leave an unlimited time for questions and answers. And we're happy to stay as long as you need to have those questions answered. So let's get right into it. So maybe counterintuitively, before we talk about bonds, we're going to talk about stock or equities. So what is a stock, otherwise known as an equity? When you buy a stock, you become an owner of that company. You take ownership in Disney, Apple, Nucor Steel. For that ownership, you're guaranteed nothing. There's a nice dividend that comes from free cash flow, and most companies value the steadiness of their dividend, but it's not guaranteed. You have no guarantee of a future return. You have ownership. On the other hand, you share in all the benefits of ownership. You share in the appreciation that comes from rising earnings, should that occur. You participate in their free cash flow through dividends, but there is no guaranteed outcome when you own a stock. On the other hand, a bond, otherwise known as a fixed income security, when you buy a bond, you are a lender. You are loaning that entity money. And for that loan, you enter into a contract, a debt covenant. And that contract says, I will loan you this money. And at a future date, you will pay me back that money. And in between the date that I lend you that money and on the date when the debt matures and you pay me back the principal, you're going to guarantee me an interest payment. That is a bond. So bonds have a guarantee, a stated interest payment, and a principal repayment at the end of that bond duration. When you are a bondholder, you are high up on the capital structure. So if you loan a company money and enter into a bond, you purchase their bonds, after paying the IRS and other mandatory expenses, they have to pay you first before they hold stockholders. So when you own a bond, you're much higher up on the capital structure. So again, stocks, you have the promise of future growth, but with a bond, you are a lender and you have a contract. And that makes all the difference in the world. So we'll move on. This is going to come back time and time again. This is how a bond works. So when the bond is issued over on the left here, whoops, all right, what did I do? Get you back, clear, okay, can't do that. So bonds are typically offered in $1,000 denominations. You can buy many of them, but they come in $1,000 units. So when the bond is issued, it's called at par, $1,000. And on that bond is a stated coupon rate. In this example, 4%. So you purchase that bond at issue for $1,000, it's par value, and it guarantees to pay you a 4% coupon. You go all the way to the right, you see the word maturity. So at some date in the future, when that bond matures, you're going to get your $1,000 back. And every year in between the issuance of that bond and the maturity of that bond, it's going to pay you $40 a year per 1,000, 4%. Whether that $1,000 is an issue of a Hewlett-Packard corporate bond, or $1,000 in a US Treasury bond, or $1,000 to the United Kingdom of Sweden sovereign bond, it's all the same. They issue it $1,000. They have a stated interest rate or coupon on that par value, and you get that $40 every year for the duration of the bond. And at maturity, you get your $1,000 back. So this brings in the definition or the consideration called duration, which is just the length of that bond. Do you want to own a 9-month bond? You want to lend the US Treasury your money for 9 months, which they would call a T-bill? Do you want to purchase a 1, 5, 10-year, 20-year, even 30-year bond? These are all considerations that Ryan will discuss when we talk about the yield curve and how to ladder your bond investments. But effectively, they all work the same. Again, issued at $1,000, your $40 a year annual payment based on that guaranteed coupon contract, $1,000 back when it matures. So those are some of the definitions that'll come into play when we discuss other aspects of the bond world. So if we go back to the idea of duration, if you were to be investing in bonds right now, obviously first you would get over the hurdle of which entity you want to loan your money to, what kind of bond you want to purchase. Subsequent to that, you have to decide what duration of bond you want. And in order to figure that out, you kind of have to look at the different maturities and figure out which offer the best value at this time. That's the consideration that brings in the topic of the yield curve and laddering. So I'll turn that over to Ryan for a definition on those terms.
Sure, thanks, Charlie. So I'll start with the yield curve. So basically, the yield curve is a way to easily visualize the interest rates on bonds of equal credit quality. You think of a graph with an x-axis and a y-axis, the y-axis being the yields and the x-axis being the maturity dates.
No.
The most commonly referenced yield curve is the, domestically that is the yield curve for US Treasuries, because they all have the same credit quality. And that referenced most commonly. Now that curve is very important in the economy because most things are based off of that, including other bonds as well as what rate you get your mortgage at. So it's an essential tool. Throughout most of history, the yield curve has been upward sloping, or a positive yield curve is another word for it. And that's where short-term rates are lower and longer-term rates are higher. Currently, though, as you all probably know, we're in an inverted yield curve, meaning that the shorter-term rates are higher than the longer-term rates, and higher by a fair amount, more so than has been in the past by a good deal. So that's actually the yield curve. Now, bond laddering, I think, these two go hand in hand. Once you understand the curve, you can understand the laddering effect. So when you build a bond ladder, it's a way to invest in fixed income, and it's essentially you build a portfolio of individual bonds or CDs that mature on different dates on that curve. It's a good way to invest to manage interest rate risk, because it's essentially like, think of diversification, right? You're not subject to the movement of one maturity. You have spread out that interest rate risk, so as the curve moves, you're not affected by one aspect of that curve moving too much in one way or the other. You can refer to, just like a real ladder, you have rungs of a ladder. Each maturity is referred to as a rung. So if you had six rungs, that would be essentially 6 different times of maturity. Traditionally, you try to equally space these. And another nice thing about laddering is you can build it so that you're getting income every month off of those investments. So you can have a steady flow of income. And another important aspect of the bond ladder is keeping it going, essentially. So as time moves on and that first rung matures, then you purchase the farthest out rung and just keep the ladder moving. Now, why you do that, or I guess how it plays out, is if interest rates move higher on the longer end, then you're rebuying, you're repurchasing at higher rates and essentially increasing your overall yield. If rates go down, then you've at least locked in on those, those beginning rungs to improve your yield or get the best yield you possibly can. So yeah, that's essentially bond laddering and yield curve.
Yeah, and this inverse yield curve will become very important to our strategy, helping clients build up the income producing defensive parts of their portfolio. So we'll get more to that later, but let's move on to another topic that created a lot of confusion for clients last year. And that is, if you stay on this bond mechanics, if you're looking at the bond mechanics slide, it kind of implies that the bonds are issued at 1,000, they mature at 1,000 5 years later, let's say, and they just stay static in price the whole time during those 5 years. And that's not it at all. In fact, the minute that bonds are issued, they go on the secondary market, and according to fluctuations in interest rates, the bond prices could go up or down below their par value at any given time before they mature. So I want to explain that a little bit as it relates to why bonds were so negative last year. And that is to explain the inverse relationship between interest rates and bond prices. So if you just take a look at the left, if interest rates are going down, the price of the bonds will go up, even well above their par or eventual maturity values. It's very foreign. A lot of clients who bought bonds 12 years ago for 1,000, as interest rates dropped post financial crisis, their bonds were trading at 1,100 or 1,200 per 1,000, and they didn't know what to make of it. So when interest rates go down, bond prices go up. And if you look at the italic under the triangle, that may create a premium or a higher valuation above the par maturity number. Conversely, if you look to the right, as interest rates go up, bond prices go down and may create a discount to their par value, such that you could buy a bond that matures at 1,000 5 years from now, you could buy it at 900. And in 2022, what happened? Interest rates shot way up. And as a result, bond prices came way down. And it wasn't just that interest rates went up so much last year, it's that they did it in a compact 12-month time frame. Normally, the rate of increase in bonds last year might have normally taken a decade. And we got all of that from basically February to October. So the jump in interest rates last year was severe. So bond prices came down. But again, regardless of whether they're at a discount or not, they will mature at their full and par value eventually. So why do bond prices go down when interest rates go up? What's the mechanic that drives that? And I answer that with the language that's written below. So this is my only techno geek part of the presentation. So bond number one, if you just follow through with me, is issued at $1,000 and pays you $40 in annual interest payments. So you divide the 40, which is your interest payment, by the issue price of 1,000, and you get 4%. So you buy that bond. But 1 year later, interest rates go up, and that same issuer, whether it's a company or the Treasury, issues a new bond. And that new bond is paying 5%. So now that bondholder is getting $50 a year instead of 40. If you wanted to sell your bond, what price would you have to sell it at to be competitive to someone who could otherwise just buy the 5% bond? Well, the answer is $800. If you sell your $1,000 for $800, someone will buy it because that $40 of interest that they're going to get divided by their investment of $800 gives you a 5% yield and is now competitive or equal to the new bond that's also coming out at 5%. So that's the math behind why bonds go up or down. And let's just say that today, as you'll see shortly, bondholders can enjoy the possibility that their bond prices will go up because now interest rates are at a significantly higher number. But last year was the comeuppance of the bond market because we had such a sharp increase in interest rate. However, the good news out of all this is that higher interest rates offer much more opportunity going forward. So we take all of it, as good news. All right, let's just take a moment to discuss what are the investment objectives of owning these different securities. Well, number one, when you buy stocks, you don't have those guarantees. So why would one take the risk? Well, when you own a share of Apple, you gain capital appreciation from the growth of the earnings of that company. And frankly, and continuously, good quality equities will generate a total return that is higher than bonds because good companies will grow their earnings faster than 5%. So the objective of an equity is capital appreciation. You get a risk premium for being an owner rather than a lender. So the long-term averages of equities are higher than bonds, and that will continue to be the case. Not always, but over long periods of time. and you get dividends on your equities for those that pay dividends from the free cash flow of the company that they pay back to shareholders in the form of a dividend. So what is the investment objective of owning a bond? Well, number one, you get the income. That income is cash in your hand that you could spend. So you get the income from the interest payments of the bond, but also in normalized times, like the 80s and the 90s, and hopefully the next decade, the income from bond interest payments has always been a viable alternative to the expected returns on stocks. So over time, if stocks are expected to get 7%, but you can get a guaranteed 5 or 5.25% interest payment on a bond, you might say, for the defensive part of my portfolio, that is an extremely attractive and competitive rate of return to the stock market. And just remember I said that because I'm going to address that in the next section. The other reason why you own bonds is for the defense against an equity correction, because most of the time when the stock market drops, particularly precipitously, there's a huge flight to quality and people will cash out of their equities and take refuge in the safety of bonds. Plus that incoming cash flow from the interest payments helps put money into your account to hasten the recovery of the account as stocks recover. So this is the historical objective of owning bonds: high income and defense against an equity correction. But here's the thing, that did not happen in 2022. And the reason why is because we're coming after the financial crisis. The Federal Reserve lowered interest rates down to nearly nothing, 1.5%, 2% rates to try to stimulate the economy. So number one objective was taken away. We weren't getting competitive interest rate payments on our bonds from 2010 up till last year. So if you weren't going to be able to meet your bills and grow your portfolio on those low interest payments, you either had to accept that and get a lower total return on your portfolio, or move money into equities, maybe more so than you would typically want it according to your own risk profile. So last year, as we came in, as we wrapped up December 2021, interest rates were still low and unproductive. Then we move into 2022, the Ukraine is invaded, we have supply chain problems and interest rates shoot through the moon. And if you remember that triangle inverse chart, that causes bond prices to devalue. And in many cases last year, bonds declined as much as the equity market. So last year, we weren't getting the high interest payments and the values were going down, so we weren't getting the defense. But we're here to tell you that that's changing. So we're going to take a look at bond yield history for a minute, and I'm going to fumble this and ask for Ryan's help. I want to take you to another place to show you how dramatic this change is and what that means is good news for new bond investors. This is the yield curve that Ryan referred to, taken right off the US Department of Treasury. So it's only dealing with Treasury bonds as our example, but all of the bonds that we're going to introduce you to are predicated on Treasury bond rates. So what are you looking at here? These are the interest rates. If you look at this chart, the heading, the date, 1 month, 2 months, 3 months. What's that? And then you go out across that horizontal top axis, 1 year, 5 years, 10 years. That's the yield curve that Ryan's talking about. And this shows you every day starting last year. So look at, just train your eyes on the 1-year Treasury bond starting the first week of last year. Anybody out there, what does it say? Just so I know you're all, someone shout out, what's the interest rate on a 1-year Treasury bond the first week of January, first day?
0.4%.
0.4. 0.4%, just a year ago. So now I'm going to scroll up and you can see what's happening here. Now we start getting all this worry about supply chain disruptions and higher costs on food and cars. Then we start to get inflation with pandemic people moving to the suburbs and renting apartments and buying homes. And now in the summer, come around September, that 1-year bond has gone from 0.4 to over 4%. That might seem like minutia to the person on Main Street, but for investors and investment strategists, that is epic. We've never seen interest rates go up that much. And what happened at the end of September when interest rates broke over 4% in all of, 27 weeks? Well, the market sold off because equities are threatened by higher interest rates, or at least a change in interest rates. And the market low, the low in the stock market, was September 30, when bonds went from 0.4 to 4.2, 4.3%. But the love keeps coming. So now we're at 4.5, 4.6. At the end of the year, interest rates yielded 4.4%. Now we get into, and excuse my reverse scroll because it probably hurts the eyes, but here we are today, 2023. And as of the close of yesterday, that same 1-year bond is at 4.99. And if I showed you the Charles Schwab yield curve, you'll see that today, that 1-year Treasury bond is now at 5.03. I mean, that is a landslide tectonic shift in the interest rate environment. So yes, it caused a ripple, to say the least, in the stock market. It caused pre-existing bonds to go down in value. But for people who are trying to create more productive interest rates, more cash flow, more defense, this is a wonderful development, because this is the equilibrium that existed back in the 80s and 90s, where if you did not want to shoulder the full risk of the stock market, you could have a competitive interest rate return on a bond, risk-free, at 5.1, 5.2%. That's where we are now. Now, our research and economics guru, Steve Worth, who I believe is on this phone call, he helped me point out a more important set of numbers, which is the real rate of return. Because if you think about it, just like your mama told you, it's not what you make, it's what you keep. So the real rate of return is the interest rate you're getting less the rate of inflation, or at least the inflation that applies to you. So if we switch to the real rates and you go to 2022, when interest rates were 1%, 2%, take a look at these numbers. What do you see? Are they positive or negative? They're negative. So interest rates were so low last year that your real rate of return after inflation was negative. Bonds were not paying you enough to keep up with the cost of living. But now, in 2023, now you have a real positive rate of return. Now you're picking up 1.5% over the rate of inflation by buying bonds today. And furthermore, if you can lock into these high interest rates today, 5% interest rates today, and interest rates and the cost of living comes down, what do you get? A much better real return, and the value of your bonds will go up. So needless to say, we're becoming much, much happier with the idea of introducing more bonds into your portfolio, should that meet with your investment objectives. So I just think that this interest rate chart is stunning. I think that it's going to get investors to a much higher rate of return with fewer units of risk. And the price of admission to get there was a lousy 2022. But here we are in a better regime. And what's the second objective of owning bonds is to create defense against an equity correction. Now, when interest rates hit their peak and bonds are at their highest level in 12 years, the next time there's an equity correction, you're probably going to see your bonds hold value or even go up a little bit as investors realize that it is once again a flight to safety. I'll fly to the safety of bonds at 5%. Maybe 3 years ago, I was not so inclined to fly to the safety of a bond at 1.5%. So that's the new value proposition. So the bond yield history is explaining how dramatic was the increase in interest rates and the opportunity that presents. I can stop now and tell you that Steve, with Ryan's help, and I are working tirelessly to identify bond opportunities to lock into these generous 5% returns and to manage the credit quality and the duration and laddering that is customary in a well-built bond portfolio. All right, so when you buy a bond, you are lending this entity money in exchange for a guaranteed interest payment and return of principal at a future date. So to whom do you lend your money? Well, you can buy a treasury bond, I should have said US treasury bond. Short-term ones are called treasury bills, intermediate are called treasury notes, and longer-term treasury bonds. They're the safest credit quality. Typically, they have lower yields, but right now, they're paying 5%. And since the yield curve is inverted, you get all that 5% on short duration bonds. And the longer you go out on the yield curve, the less you get. So right now, we're firmly concentrated on the shorter duration treasuries. But it's the highest credit quality because the treasury can print money, which we all know they've done over and over again. Then we have government agency bonds that have the same basic credit quality as the treasury, but they're quasi-government agencies like Fannie Mae and Freddie Mac to buy mortgage bonds, and then special agricultural bonds, other types of bonds like historically Sallie Mae, which is loaning money for student loans. Most of the money is in corporate bonds. So we're concentrated on individual, well-rated, strong companies like Goldman Sachs, Morgan Stanley, ConAgra, Hewlett-Packard, Boeing, and they're paying a little bit more with some of these corporate bonds, particularly if you remember the definitions. Some of these corporate bonds, because they were issued previously and interest rates have gone up, many of these corporate bonds we could purchase at a discount so that you get your interest rate plus a little bump when the bond matures. So corporate bonds are a focal point for us. You have international treasury and corporate bonds. International treasury bonds are often called sovereign debt. So you can get the treasury bond of Mexico, Ireland, Sweden, the UK, Brazil, China, South Korea. And then we can often find good deals in corporate bonds in international markets like Nestle's, which for all intents and purposes is a multinational corporation. Steve has also pointed out that we're considering using international treasury bonds in that if the value of the US dollar declines, we might get the opportunity to see some modest appreciation just on a currency basis. Then, of course, the preferred bond strategies for people who are in a high tax bracket, municipal tax-free bonds. So you're buying a bond for the state of Connecticut, state of New York. Sometimes you're buying individual revenue bonds like the GW Bridge or a SUNY of New York dormitory bond that they use to fund the building of dormitories, and they guarantee those bonds. And you have to decide whether that credit quality is sufficient for you. Convertible bonds is not normally a part of our portfolio strategy, but it's important to know what they are, which is just a corporate bond that allows you to convert your bond into the equity of that company at a predetermined ratio. And they're often used for upcoming tech and innovation companies where if their stock goes through a wonderful period of appreciation, you can convert from the bond to the equity side. But while you're waiting for that, you get an interest payment as a bondholder. The last category is something that we're introducing for the first time, and that's private debt or private bonds. So equities get all the drama, right? Whenever there's something major in a market rally or a market meltdown, it's always the stock market that's on the cover of the Wall Street Journal. But the US equity market, Steve, is about what size in trillions?
I believe it's 80.
$80 trillion. That's where all the drama and the focus is on that small incidental $80 trillion block of money. The bond market makes that look silly. The bond market is twice that big, 160, 170 billion. Trillion, I'm sorry. And most of that is publicly traded, as we're doing now, buying these bonds into your portfolios over the bond market exchange. But there's a whole nother world out there in private debt where companies will go through mezzanine financing and other private sources to borrow money, and private entities offering that money to be a bondholder. And oftentimes that private debt not only pays a higher interest rate, but because it's not traded on the exchange every day, subject to the emotional vagaries of the market, oftentimes private debt offers a much more quiet ride along the way with a higher interest rate. And now there are public ways to access private debt. So we, of course, have our eyes on all of this. And Ryan, coming from the world of a bond analyst, knows how all this works, and he's working to identify the best opportunities. And Steve and I are working to figure out how this fits into clients' investment objective and where it lands in your portfolio. But these are the types of bonds. And as you can see, there's more than enough opportunity, and interest rates have been going up dramatically on each of these categories, as we've talked before. So this is the completion of the slide portion of it. I'm going to give a quick summary and then open it up to Q&A. And the summary is just that historically, bonds pay in the 5-6% range and offer a wonderfully competitive alternative to equities. So we, as a portfolio group, as an investment advisor, are following those interest rates higher to try to make it as productive as we can for your portfolio. But this is a new paradigm. This has only been made available to us since around July of last year, and it represents a wonderful sea change from the almost inert, ineffective, unproductive bond market of the last decade. So there are better things ahead for you folks if you were to include bonds in your portfolio, and we're looking forward to living through those days. So that's the end of my scheduled presentation. So Dave, why don't you turn on the ABBA music and we can open it up to any questions that you all have.